Hi, everybody. Good afternoon. Sarah Springer here, broker owner of Pathways Realty. I welcome you to this video chat session that I'm going to be having with Robert Garnett today. Thank you so much for tuning in, and we hope what we're going to share with you today will be insightful, educational, and beneficial to you. Take care. So what about those borrowers that are, looking to make their first purchase or a move up or move down purchase? Obviously volume is volume, but this is a different, somewhat of a different process than a refinance. So what are you seeing with how the credit crunch is affecting, these borrowers, and is there a tightening of the guidelines that's currently happening?
There is a tightening of specifically a lot of the government lending guidelines.
Mhm.
In the past, on some of the government-backed loans like FHA and VA, we could go down as low as a 520 credit score as long as there were strong mitigating factors.
Wow.
Now, those minimum credit score requirements have gone up significantly. For most, usually for most of the government lending, they're now requiring at least a 620 credit score, possibly higher, again, depending upon the lender that you're working with and their access to credit. What I will say, though, is that for the purchase timeframes, again, both the company I work for and most other lenders out there put a higher priority on transacting the purchase business than they do the refinance business. So still, from what I've seen on our end, most purchase closings are still proceeding within a timely fashion in 30 to 45 days because they're putting that emphasis on making sure that those transactions close within their proper closing dates.
So time to close for those buyers on these purchase contracts is pretty much about average still. It doesn't sound like that's really slowed down at all.
That's correct, yes.
Are there any other credit guidelines that have changed besides credit score and things that are being evaluated for borrowers now?
Well, again, there was many instances where if someone did have a good credit score, but they possibly had a higher debt to income ratio, possibly over a 50% debt to income ratio, as long as they had an approval through the automated underwriting systems that we use through Fannie Mae and Freddie Mac, a lot of times we can still proceed with those. But as of right now, they have capped out those debt to income ratios at a maximum of 50%. And we are still seeing some more heavy scrutinization of the documentation that we're getting in, mainly because we don't want, when a loan closes, for it to be scrutinized to the point where it's returned back to us. That again eats up our liquidity as a lender and prevents us from being able to lend that money back out to get more loans in.
Okay, very good. Thank you, Robert, for your time today. I appreciate all your insight and sharing it with the public, and I hope that you continue to originate these loans and help people get into their houses.
Thank you.